Well, good afternoon, everybody. It's great to see a full house here today and so many familiar faces. Before I kick off, I'd like to acknowledge the traditional owners, the Wurundjeri people of the Kulin Nation, as the custodians of this land, recognising their connection to the land, water and community. I pay my respects to Australia's First People and to their elders past and present. For those that I haven't met, my name is Daniel Moore. I'm the State Manager for Perpetual Investments here in Victoria. And on behalf of the broader business, I thank you for coming today and thank you sincerely for entrusting us with your clients' wealth as we go through the journey together. A little bit of housekeeping. Everyone knows the rules about mobile phones? Yes, we're getting a few nods. Just please put them on silent, but keep them close by. You will need them during the Q&A session, where you'll be able to text in some questions to our speakers. Today's presentation will also have CPD points. So to qualify for your CPD points, please just complete your feedback form. Okay, put all your details on it, and please give us any feedback you feel necessary to help improve these sessions going forward. We have a great lineup of senior speakers from our business today. Our first speaker will be our CEO, Rob Adams. Rob will be followed by the Head of Equities, Paul Skamvougeras. Paul will be followed by our Deputy Head of Equities, Vince Pezzullo, who will then be followed by Anthony Aboud, Portfolio Manager of the Industrial Share Fund and some of our long-short strategies. As I alluded to earlier, we'll run a Q&A session. So those gents will all be on stage. They will also be there with Nathan Hughes, who's recently been promoted to the Portfolio Manager of our Ethical SRI Fund. You'll see on the screen at the moment there's a mobile phone number, so it might be a good idea to jot that down. You'll be able to text questions through at any stage during the presentations for questions you would like answered. For those who are a little bit more old school, we will have roving mics. People that like the sound of their own voice, like me, feel free to use the mic instead of texting, but we encourage questions either way. So if you've got questions from your clients you'd like answered today by the Perpetual Investment team or our CEO, please ask them. That's it from me. I'm going to welcome onto the stage the CEO of Perpetual, Rob Adams. Thank you.
Thanks, Dan. Good afternoon, everyone, in this long room. I'm glad we've got a big screen. I think we've got slides in front of you as well. But please enjoy your lunch while I just make a few opening remarks before handing over to the people that really matter, and that's the people who are managing your clients' money. On behalf of the Perpetual team, like Dan, I'd like to thank you for taking time out of your busy schedules to be with us here today. As we all know, time is an increasingly precious commodity, so we thank you for spending some of yours with us here today, and I'm quite confident that you'll get some real value out of today's session. You may or may not know that Perpetual commenced operations back in 1886. It's a brand that's been around now for pretty much 133 years. The name Perpetual was chosen very deliberately by the founders of the business back in 1886. And its core original purpose of providing trustee services, looking after people's assets, was such a critical purpose, the business in their minds had to last into perpetuity, hence the name. Since 1886, Australia has of course been federated. We've seen 2 world wars, we've seen a Great Depression, we've seen the global financial crisis, and numerous other events that have impacted money management. And throughout this time, Perpetual has been very focused on delivering to clients and being true to that original promise of our founders. Perpetual today continues to serve clients across our 3 businesses, Perpetual Investments, Perpetual Private, and Perpetual Corporate Trust. With that background, and knowing that the trust that is associated with the Perpetual brand, and having personally competed with that brand over the last 30 years of my career working at houses like Colonial First State, Challenger and Janus Henderson, It is indeed a privilege to now be leading this company, even though we all, as participants in the Australian financial services... Did you just lose me? You got me back? I'm back. I was just talking about what a privilege it is to be leading this company, even at a time when, as participants in the financial services industry, we all face a number of significant challenges and change. Perpetual has been actively managing public Australian share funds for more than 50 years, longer than anyone else. Over that time, through the most challenging of times, Perpetual has delivered to clients. Those challenges have been particularly difficult for Perpetual in recent years, as growth and momentum have won out over value for what is now the longest period in history. Today you'll hear in more detail from our equities team, led by Paul Skamvougeras, and how they are navigating through this difficult period. And whilst I, as CEO of Perpetual, cannot guarantee investment outcomes, what I can do is fully commit to 4 very important things. Firstly, we strongly believe in the critical role that financial advice plays in Australia, and we will support you in that role in whatever way makes sense and whatever way adds value to you, your business and your clients. Secondly, Perpetual will ensure at all times that we have the very best people with the best resources working in the right environment to deliver the best possible outcome we can. We are deeply committed to quality investment outcomes over time. Thirdly, we won't be distracted by what's happening around us, but we will remain committed to a proven investment approach that has added substantial value over the last 53 years, and we're confident it will continue to do so into the future. And lastly, going forward, we at Perpetual will invest more into ensuring that you have access to our people, our resources and our information in a manner that will assist you in your relationships with your clients over time. Having now worked with Paul and the broader team for the last 8 months, I can say with some authority that this team is completely dedicated to the task of adding value over time. Whilst we recognise that near-term performance is not delivered to our nor to your expectations, we will continue to commit all that we have to this core task. Having seen many investment cycles myself, I feel very confident that we will be seeing a return to value being back in favour and delivering superior returns. I'll digress for a minute actually and give you a brief personal perspective. I've personally been an investor in the Industrial Share Fund since 1994. As an investor in the Industrial Share Fund, I've seen the cycles that you and your clients have seen, and every time we've seen Perpetual deliver through the back end of that cycle. As I mentioned, it just so happens that this is the longest cycle where growth and momentum have won out over value. But I certainly know from my perspective as a long-term investor in this fund that there's one team that I want to be running my money at the back end of this cycle, and that's the Perpetual Australian Equities team. In my judgment, I want to be a beneficiary of that proven investment approach that has come through so many cycles in the past. But, of course, I'm not a money manager, I'm a business manager, and so it's far more valuable for you to hear from the former rather than more from the latter. So with that in mind, I'd like to now introduce you to Paul Skamvougeras, the head of Australian Equities. Paul has been successfully managing money for more than 20 years now. And as I mentioned, he is the head of our Aussie Equities team. Having worked with many Aussie equity managers over the years at some of the shops I mentioned earlier, I can say with some authority and absolute confidence that I've rarely come across a more driven and passionate investor. But you can make your own judgment. Please welcome Paul to the stage.
Thanks, Rob. Welcome everyone to the Roadshow, Perpetual's Roadshow for 2019. My name is Paul Skamvougeras and I'm the Head of Equities at Perpetual. Being the Head of Equities is both a great privilege but also a great responsibility, which only a handful of people have had over the decades. So for me, it's a very important role and I take it very, very seriously. But it's not just about me. At Perpetual, we have a truly exceptional investment team and many of whom are with me today that you will hear from later on. And as a team, we're really passionate about investing. We spend a lot of our time thinking about our portfolios, going out and visiting companies, talking to companies, finding out things. We're quite a curious bunch. But we love spending our time picking over stocks. But whilst our distribution team visit you regularly and we communicate via our newsletters, I thought now was an ideal juncture to actually once again talk to you directly about the current state of the markets, how we at Perpetual see the investment world, and how we are investing your clients' money during these very, very interesting times. So many clients over the years have entrusted Perpetual with their money, and Perpetual as a professional fund manager has been around for more than 5 decades with the launch of the Industrial Share Fund back in 1967. As you'll see in today's presentation, over the long term, we have a very proud history of delivering strong returns for our clients. Not just better returns than the market, but crucially, with lower risk than the market. This has always been an important and distinguishing feature of the way Perpetual delivers quality value investing for clients. In fact, not that long ago in WA, we had a client call us up to thank us because the annual income on his investment in the Industrial Share Fund had exceeded his original investment around 25 years earlier. In a single year, he'd gotten back the size of his original investment, his entire original investment, and still had invested funds several times his original investment. And I guess that's a great reminder of the power of compounding solid returns over time. And our ability to make a real difference in the financial lives of our clients is really what gets us up every day. More recently though, our returns have been challenged compared to the market. And right now, for us, the economy and equity markets are lit up with a number of warning signs, what we consider red flags. That makes our roles as investment managers more difficult, but also more important than ever. Put simply, we are late in the cycle. What we see, a slowing global economy, a mature business cycle, exhausted policy stimulus, historically low interest rates, lots of leverage in the system, both corporate and household, trade wars and political disruption is everywhere. Yet the markets are trading close to highs, and this doesn't really make a lot of sense to us. Markets are trading today as there are no risks on the horizon, and investors in turn are really only focused on the returns that they're getting. And this, in our view, is a very dangerous combination. And it's times like these when it looks so easy to make money that some of the greatest investment mistakes get made. And value investing, one of the great wealth creators over the last century, has had its toughest ever period in recent years. And I'll have a lot to say about that during the presentation today. But I guess the key message is, we have seen this before. I've seen this before. I worked at Perpetual during the tech boom in 2000 under Peter Morgan. I was working on the dealing desk. This was another really challenging time for Perpetual, but also for value investing. The market behaviours we're seeing today are not very different to what we were seeing back then. We have large companies that are loss-making, trading at big valuations, and investors convinced of future profitability of these firms and that it will emerge at some stage. For some of these companies, that may well be the case. They may make it to profitability, but investors are very complacent about the risks at hand. So on to the presentation. So as I said before, we believe we are very late in the cycle. So what exactly does that mean? Well, in this slide, you can see that the cyclically adjusted PE of the market in the dark blue, relative to history, is very high. It's not as extreme as the tech boom, but it's starting to get up there. So valuations of equities are very high. Interest rates, which can be seen in the light blue, are historically low. Many investors you'll talk to will argue that valuations are justified given interest rates are historically low. and are likely to stay low for a very, very long time. That is a valid argument. But just to give you a sense of the times that we are in, of the outstanding sovereign debt of US $37.5 trillion today, 42% of it is issued by countries where bond yields are mostly negative. These are truly unprecedented times. Moving on to Australia. High growth stocks in Australia, and that is stocks with EPS growth greater than 20% over the next 2 years, trade at a forward multiple of 38.9 times. This is a massive 62% above the global average of 23.5 times and 25% higher than the second most extensive market for growth, the US. Now, Aussie interest rates are low, but relative to the globe, we are still relatively high, I would argue. But the valuation premium that Aussie investors are prepared to pay for structural growth stocks is extremely high relative to other countries. You could say Australian high growth stocks are in a bubble. So, PEs are very high relative to history, valuations are high. According to many investors, justified because interest rates are historically low. So does the earnings outlook support these high valuations? Well, the global economy has been slowing now for 3 quarters, and this is already starting to show up in corporate profitability. The most recent US reporting season, we started to see lower overall EPS growth, lower net beat rates, lower margins, and weaker guidance moving forward. So earnings growth is slowing. This makes us cautious. In Australia, during the most recent reporting season, we met a lot of Aussie corporates, and the key takeaways were that margins were under pressure. There was a lot of cost input pressures, a lot of wage pressure, and the earnings outlook is a bit cloudy for Aussie corporates. And most recently, in the last 2 months, we've started to see quite a few downgrades on a weak second half from a number of Australian companies. But just to give you a flavour of what's happening in Australia, margins for listed companies are above the long-run average for about 70% of companies today. So we've seen the good times, but consensus still expects 80% of these companies to deliver margin expansion over the next 2 years. Now, given what we've just gathered from the most recent reporting season, we don't believe that's very realistic. Another reason why we're cautious is there is a lot of leverage in the system. Naturally, with interest rates very, very low, it encourages more borrowing. Total net debt of ASX 200 listed companies is currently around $390 billion. It's close to double what it was just prior to the GFC. Earnings have grown, so debt as a percentage of earnings has been trending down. However, a lot of the corporate debt that has been put on balance sheets recently has been used to conduct buybacks. And you can see there's been a noticeable pickup in buyback activity in the first half of 2019. This has been quite supportive of EPS growth. But I guess with interest rates so low, serviceability of increased debt is not really an issue for Aussie corporates today. One of our key quality filters is companies with strong balance sheets. That's what we really focus on. And in this low interest rate environment, this has not really been rewarded at all in our portfolio. However, as the earnings outlook weakens, or if it were to weaken significantly, it would be somewhat of a different story. I've been investing now for 20 odd years, and late in the cycle, in my experience, balance sheets become really important. And chasing companies with weak balance sheets or high leverage almost always ends in tears. There is no room to manoeuvre when things go wrong for management, if operating conditions deteriorate. There's no flexibility or optionality for the company to take advantage of opportunities that may arise. And at the same time that corporates have taken on more debt, Aussie households are really leveraged as well. So as interest rates have fallen, Aussie households have continued to stack on more debt. Australian household debt to income is one of the highest in the world. With house prices falling and debt high, this could really have an impact on the Aussie economy and earnings outlook. And we've seen a little bit of a window into that, especially in the last 6 to 12 months as house prices have fallen. Consumption has really come back, and the economy has been growing well below what the RBA expected. And I think a lot of that has to do with households being under quite a lot of stress. So that's something that we're focusing on. Unemployment's probably the key data point that we focus on there. We think if unemployment were to tick up, we'd have a real problem in the economy, and that would have a flow-on effect to corporate earnings. Because if everyone's got their job, they can service their debt and they can still consume, and everything's relatively okay. But once it gets out of balance, there could be a real problem here. But putting it all together, we've got very high valuations, we've got a slowing earnings growth, very, very low interest rates, and a large amount of leverage in the system, both corporate and household leverage. So when we put it all together, we think we're very late in the cycle. And we think also that investors today are too focused on chasing returns. Everyone's about chasing the returns without thinking about the risk that they're actually taking, given where we are in the cycle. And I think that's the most interesting thing. It's about the risk. So that leads me to performance. And we have a conservative, value-based investment philosophy, and we have underperformed over 1, 3, and 5 year period. And we're quite frustrated by that, myself and the team. Over a 10-year period, however, we've delivered strong absolute and relative returns with less risk than the overall market. I guess from my point of view, many members of our team, I don't know if you know this, but many members of our team are invested alongside your clients in the funds. We're all invested in the funds, and we do understand the huge responsibility we have in managing other people's money, and we don't take that lightly. And although we are disappointed with the returns, we're all really working hard to improve those returns. So, late in the market cycle as we are is probably where our investment process is the most challenged. When valuations are elevated or extreme, we tend to underperform. And you can see on this slide, the industrial share fund underperformed prior to the tech bubble and also the GFC. But what's interesting about this chart is the current multiple of industrials ex-financials is near the tech bubble levels. Now, we are underperforming. Nonetheless, we are sticking to our investment process and philosophy, as it's proven over many market cycles to actually generate strong long-term returns for our clients. What I thought I'd do here is break down the last 10 years over 5-year periods. This is the first 5 years coming out of the GFC, and both Concentrated Equity Fund and Australian Share Fund really outperformed the index. And I put that down to our investment process and our focus on strong balance sheets. That really held us in good stead coming out of the GFC. So focusing on strong balance sheets, companies that had sustainable dividends or dividends that they could grow really delivered for us. Value was in abundance, of course, and high-quality companies were trading at reasonable levels. But as QE3 commenced and interest rates started to fall, we've really struggled, especially in the last little period, but we've really struggled over the last 5 years. And the reason being, we've seen a huge re-rating in the market of companies that have exhibited above average EPS growth. And really, we've been left behind more so than poor stock selection. A lot of what you see in our underperformance is we've just been left behind. We're not participating in the last part of the rally. So I get asked a lot whether value investing is broken, because it's been quite a long period of underperformance relative to growth. And to give you a sense of the headwinds value investing has faced, this slide highlights the divergence in performance between growth stocks listed on the ASX versus value stocks. And growth stocks listed on the ASX are up almost more than 200% since 2012. And value stocks have been flat over that period of time and have underperformed the market. And I think in this very low interest rate environment, investors are willing to pay higher and higher and higher multiples for companies that have above average growth without thinking about, well, are the earnings actually going to justify that growth in the medium term? So we're seeing that. I also think what's exacerbating it is a lot of flow of money to passive is really exacerbating this trend. But what I would like to say is we are late in the cycle. Investor behaviour has changed. You know, the risk-reward argument today, it's not balanced. Too many investors are focused on what can go right, on the short-term price and earnings momentum, and are less focused on fundamentals. At the moment, it's all about upside with very little consideration of the downside. And being conservative investors and focused on fundamentals, we're finding it challenging. The thing that we really focus on is valuation. We have a strong buy-sell discipline that centres around valuation. To us, the price you pay for an asset is extremely important to your expected future returns. And although valuation discipline is an excellent guide to long-term returns, in the short term you can look quite foolish. At Perpetual, we're also an active manager, and a large percentage of active managers at the moment are struggling to outperform the index, as you can see from the slide. It seems right now passive strategies and the machines are winning. But to sum up, value and active strategies are by no means broken. They are cyclical, and we are at the bottom of the cycle in terms of value and active management. And in times like these, especially late in the cycle, where we are starting to witness silly investor behaviours, is the time you need sensible, conservative managers of your money. The perpetual investment process and philosophy has seen many market cycles and manias, and we continue to stay true to our label. It's very simple. We like to buy assets low, sell them high, and we're not afraid to go against the herd. So we touched on a little bit of on the rise of passive investing, and I thought a quick case study might give you a better understanding of what we mean and what we as an active manager are actually competing with today. So in case you didn't know, Perpetual is listed on the stock exchange. Perpetual's largest holder, the largest that I can remember in its history, or for some time, is BlackRock. BlackRock's the largest quant manager in the world, an ETF manager. It owns 12.5% of our company. So you might ask the question, well, why does it own 12.5% of Perpetual? Well, Perpetual stock was included in the iShares International Select Dividend ETF because of its high historical dividend yield. Historical. The orange shading indicates when the ETF bought and the market impact it had on the stock price. So this ETF has bought $230 million odd of Perpetual stock without meeting our new CEO, without assessing our new strategy, without assessing the changing landscape in funds management and financial advice in Australia post the Royal Commission. It bought Perpetual stock based on one factor only, its trailing dividend yield. So I compare investing in this way to buying a house online without an inspection. I'm not sure many of us would do that. And so investing in ETFs no doubt is cheaper in the short term. However, I just wonder in the long term, could it end up costing? So what does this all mean? Well, we said we're late in the cycle. And I think in these challenging times, we at Perpetual want to always be the fund manager that you can trust to do the right thing at the right time for your clients and not get caught up chasing returns or fear of missing out. We want to be the one you can trust at the best as well as the worst of times in markets. And we will never take that trust for granted. So, thank you for your time, and I will hand over to Anthony Aboud.
I'm Anthony Aboud. I've worked at Perpetual for over 7 years and I've been in the industry for about 21 years. I run the Share Plus Fund, I co-run the Pure Equity Alpha Fund and I co-run the Industrial Share Fund. I love working at Perpetual. I'm proud to be part of all my funds, but Industrial Share Fund is the oldest managed fund in Australia. It's been run by quite a few very high quality portfolio managers over the years. And whilst they've changed, the whole the style and strategy has not. Over many decades, these portfolio managers have managed to find some cracking investments, but more importantly, they've managed to avoid most of the blow-ups which have littered Australian corporate history. Over the long term, performance has been excellent in both absolute and relative perspective. I've only been taking over the fund for a relatively short period of time, and I hope to get it back to that long-term strong performance. Today I'm going to talk a bit about what I see as my responsibility as a portfolio manager, some red flags we're beginning to see across the market at the moment, and some of the ludicrous justifications some people are using to justify current valuations in the market. As stewards of other people's capital, our goal is clear, and that's to outperform the index over the medium term. Our strategy to achieve this is to focus on quality and value. More specifically, we want to obviously find some cracking investment ideas. We want to avoid investing in hot sectors or getting sucked into hot sectors, and also avoid value traps. If I start with good long-term investments, clearly the idea for us is to invest in good companies with good management, with a great balance sheet, at an extremely cheap price. Now, these opportunities don't fall out of a tree, so we've got to find things with a few hairs on them. It might be that the company's a good company in a good industry, but we need to change management. Or it could be a good company with good management and good industry, but it's really hidden from plain sight because the short-term earnings are quite poor. We have quite a strong buy-sell discipline, but we're happy to hold companies for decades. Some examples of this are Event, Soul Patts, or even Reece. Take Reece, for example. Perpetual first identified this as investment back in 1991. Outside of the founding family, Perpetual has been one of the largest institutional investors for over 2 decades. When we looked to buy it all those years ago, it was not known. It was actually not well liked by the market. In fact, up until a couple of years ago, it was only covered by one analyst. And now it's actually a bit of a market darling. It's well known, well liked, etc. But this has been one of our great investments. The second thing we try to do is to avoid hot sectors and stocks. Now, finding good investments is not natural for most humans. Human emotions tend to swing wildly from fear to fear of missing out. When a sector or asset class is hot, everyone wants to buy it. If I had $1 for every single time someone asked me about cryptocurrency 2 years ago, I'd be very, very rich. Especially if they paid me in dollars rather than Bitcoin. Also, I mean, if I think about all my friends who were telling me about all those Babcock and Brown satellites and Babcock and Brown back in 2007. And then I was called a dinosaur back in the late 90s for not wanting to own DavNet, Solution 6, Sausage Software or News Corp. A dinosaur? I was in my 20s back then. The other thing is to steer clear of value traps. Now, the biggest mistake value managers like us make are getting invested in value traps. And what is a value trap? Well, that is a company where it looks cheap on a PE on a one-year out basis, but if over the next 5 years the earnings halve and the PE stays the same, the price halves. That's not a good investment. For us, that's one of the most important things that we need to steer clear from, and something we spend a lot of our time making sure we don't get sucked into value traps. Examples over the past could be some of the media names, your Channel 10s of the world, or your Paperlinkses or your Myers, etc. of the world. Red flags. Red flags is something that we really do focus on quite a bit in Perpetual. What does it mean? I mean, what we try and look for is companies or management teams which exhibit red flags. And what we're trying to do is analyse their behaviour either through what they say, how they act, or something, or through their accounts, to sort of get a read into the psychology of the management team. And the idea is that they probably know the problems, either consciously or subconsciously, before the rest of the market do. So understanding that behaviour is very important. What are some of these red flags? You can see them up here. Insider selling, pretty self-explanatory. It's a board member, CEO, management, founder, selling. It's always for the same reasons. It's usually buying a house, tax or divorce. But we sort of are a bit sceptical, and often it's a good lead indicator. A sudden change in CFO, especially for us, is a red flag. And that's the reason CFO is because the CFO does tend to know the problems before the rest of the management team do, and they can really get themselves out much more easily. A strange acquisition. Now this is a bit subjective. We're a bit cynical of most roll-ups for roll-up's sake. Not all, but we are a bit cynical of them. But the other one is a strange acquisition. What we consider a strange acquisition is out of private equity, it's a complete change in strategy, or it's a very expensive price. The next one is over-promotional management. This is CEOs who are constantly out there telling brokers, etc., how good their business is, or they can never, ever release any bad news. Everything's positive. Something's bad happened, but that's a positive. And that's something which we're a little bit cynical about. CEOs who berate short sellers. Now, I take particular offence to this. Because I have done, in the funds we do short, and I've been a short analyst in the past, and two, and the second reason is because some unkind people call me a short analyst. The last one is we call aggressive accounting. What we mean by this, and just very simply, there's a lot of different things that we could relate to here. That is taking one-offs below the line, cash which is not matching accrual earnings. But basically, when a company tries to make earnings look better than they actually are, and that's something which we look at in a lot of detail. Now, none of these are reasons in themselves to sell or to sell a stock. But what we do is it causes us to stop and give pause and make sure we really are on top of our investment thesis. Now, a lot of this to everyone here would be probably common sense, but none of this comes into consideration when ETFs or passive funds come and buy and sell stock. I thought I'd run through a couple of examples of historically where red flags have served a good purpose for us and allowed us to sort of predict what could, something could go wrong. I'll start with aggressive accounting. I mean, there's an old saying which is revenue is vanity, profit is sanity, cash is reality. At Perpetual, we do focus heavily on cash and cash generation, and more specifically, sustainable cash generation of a company. More recently, the market is heavily focused on the revenue and the revenue generation of a company, mainly because a lot of the companies don't make any money. But in more normal market environments, it's the profit which most of the market focuses on, but we're still a bit cynical about that because it can be manipulated. Let me give you an example, Slater & Gordon. This was a market darling back in 2012, 2013, 2014. We owned it going back at the early part of this decade. But it started exhibiting some red flags because it started rolling up the legal services sector, and we thought, geez, they've been quite aggressive here, but that was fine. Then, come about August 2014, came out with a result which the market cheered and thought was fantastic, but we started saying, oh, hang on, the cash flow is not really matching the earnings. The cash conversion is 67%. We think this should be doing about 90%. And so we said, okay, well, there's a few red flags here. Then the following year, March 2015, the company announced an acquisition, a large acquisition of Quindell. It's a UK company, similar business to them, but it was essentially a massive roll-up itself, and it had a few auditing issues, hadn't had a proper audited accounts for 18 months. But the size of the acquisition was a surprise for us. It doubled the size of Slater & Gordon. They were betting the farm on this company where we felt elevated risk. We definitely put it in the strange acquisition. Market loved it because it was massively EPS accretive, which is what everyone seems to base what makes a good acquisition, which we disagree with. But after the initial euphoria came the hangover. In June 2015, ASIC revealed it was doing a review of Slater & Gordon accounting. Then in October, the CFO left suddenly, and the rest is history. we're starting to see across the market a bit of a deterioration of cash conversion. Not the end of the world, but it's something we're keeping an eye on, especially in certain stock-specific examples. Next example I was going to give is just a sudden CFO departure, and the example I'm going to give is Treasury Wine back in June 2013. The well-regarded CFO left, and he said he's going to leave in 2 days. Now that for us was a bit of a red flag. Sure enough, 2 weeks later, $85 million write-off of inventory value, a provision, and a warning that next year's sales out of the US is going to be materially weaker because they've channel stuffed. Share price fell 20%, and 2 months later the CEO left. The next example is insider selling. It's probably still a bit raw. This one is it's quite recent. Reliance Corporation, a success story in Australia. April 2016 it listed. Good management, decent company. We actually owned it early on after it listed, but then it rallied quite a lot, and it got to a level of about 24 times P, where we thought, geez, it's quite expensive for a company which provides plumbing equipment predominantly to Home Depot and Lowe's in the US. And we thought, well, geez, Home Depot and Lowe's, they make Coles and Woolies like little pussycats. So we thought that's not the sort of business we really want to, we think that's the wrong price. Then in January this year, the company came out, not with a profit warning, but saying, look, we're going to meet guidance, but it's going to be second half weighted, and we need a freeze event to happen in the US. And so we often come to the view that once a company uses weather and second half weighting to meet their guidance, we call that hope. And that's sort of, we worry when they come to that. Then the result came out in February now, and we identified that the cash flow was poor, and the core business was actually going backwards. They made a big acquisition just 12 months previous. But the core business was starting to go backwards, and that was a bit of a concern for us. So we considered that to be a low quality result. And 2 days after the result, the chairman, founder, and left the board immediately, sold the stock, $367 million worth of stock, and sold his stock at $4.65. Still, the market liked it. They'd gobbled it up, and the stock traded back up to $5 not long after. We were scratching our head a little bit, saying, okay, well, hang on. The company just made a large acquisition 12 months previous, pretty expensive multiple. It was, they had a low quality result. The founder and chairman sold all their stock and left the board. And the stock was trading on 24 times PE. We thought this is a bit strange. Sure enough, 3 months later, after the founder sold his stock, they came out with a profit warning. The stock fell 20%. It's now trading around $3.60 today relative to the $4.65 where he sold out. Now, this is just one example of insider selling being not a bad lead indicator. It doesn't have a 100% hit rate. It doesn't mean anytime there's insider selling, stock's going to fall. But for us, it's a reason for us to have a really go over our investment thesis. What we're also beginning to see across the market is that in the last couple of years especially, a real step up in insider selling. And that 2019, that's just the first 4 months of this year. And so we're starting to see that's actually, if you annualise that, could be quite a big year as far as insider selling is concerned. And that doesn't include the fact that the Murdochs sold their content business to Disney, the Lowies sold their property business. And what we're starting to see is the smart money are starting to take some chips off the table. What I've got next is, I guess, just a list of companies which over the last 6 months have had large insider selling. Again, I'm not saying all these are sells by any stretch of the imagination. I'm just saying, but one thing they've all got in common, they're all very well loved stocks, and they're all done extremely well in the last 12 months. Just worth making sure everyone's on top of their investment thesis on all these. Now, I don't often read strategy pieces from brokers. However, I pulled one up the other day from a very well-respected strategist saying around a third of the Australian market is made up of the tech sector. With earnings revisions in this sector strong, and with many of their companies priced off global long-term profit growth prospects, there is very little reason to expect that the recent sharp run-up in this sector will unwind. That was March 2000, and that was really the consensus call. The average P of the tech sector in Australia was 45 times. News Corp, which then was considered a tech company, was trading on 35 times. Telstra, which in a funny way was also considered a tech company back then, was trading on 24 times PE. and it just bought stakes in Sausage Software and Solution 6. We know how that ended for them. What we are beginning to feel, what we feel is that we're beginning to read research and investment reports which are using very puzzling logic to justify the current dizzying valuations that we're seeing. I'll give a couple of examples. Afterpay. Now, look, the buy now, pay later sector has definitely taken Australia by storm. It's minimal credit checks. They can lay by product and receive it up front and pay equal instalments. I think we all know how it goes. Afterpay takes the credit risk and gets paid by the retailer about 4%, and also from late fees. It's a good novel model, and they've executed flawlessly. But at the end of the day, it's purely regulatory arbitrage. And if history repeats itself, this regulatory loophole will be closed at some point in the future. The irony is not lost on us. The fact that while the banks were getting beaten from pillar to post during the Royal Commission for irresponsible lending or lack of responsible lending, these guys were growing exponentially with very little credit checks. Now, we believe one of two things is going to happen. Either the buy now, pay later sector gets regulated and falls under responsible lending, either here or overseas. Now, in which case, I believe, obviously, that will be a big headwind in the short term, but make it a more sustainable business model. Or nothing happens and there'll be tens, maybe hundreds of competitors. Now, bear in mind, in our opinion, credit is a commodity. I know everyone says, oh, yes, I'm only going to buy this if I can afterpay this. But over time, as more and more buy now, pay later comes up, if you're going to buy that handbag or the dress, you're buying that. You're not saying, oh, okay, I'm only going to buy this if it's got afterpay. It is a commodity what they're offering. And so when we speak to retail chains at the moment, two of the biggest ones, the early adopters of Afterpay, they're both very actively promoting non-Afterpay buy now, pay later. Because for them, it's not just the 4%, which is the cost. If a consumer returns a good, and there's up to 50% returns on some on labels, they still have to pay that 4%. So the retailer hasn't sold anything, but they're still paying 4% away to Afterpay. It's an expensive form of distribution, and they're looking at ways to sort of cut it back. The point for us is we believe that at some point in the future, even the disruptors get disrupted. Now, what we've got here is, I guess, a justification after the last earnings result for Afterpay. And said this has resulted in a sizable downgrade to EBITDA forecasts in FY19 to 21, but a 22% upgrade in FY22. And our valuation, though, is up 95% to $30.06 as we start to incorporate FY23 into our earnings capitalisation method. As an aside, that FY23 revenue forecast is a tenfold increase in what they're doing now with no margin compression in terms of revenue margin compression. I find it miraculous. The analysts are unable to predict 6 months or 12 months ahead, but can base a valuation on 5 years ahead. Maybe they're right, but this smells a lot like market participants chasing a hot sector with little regard to long-term fundamentals. The last example is IDP education. This is a good business, student agency business. It sources and brings to Australian universities students from India and China. Again, not much debt, well run. It's in a nice spot at the moment. The thematic is pretty good, but a lot of their revenue is generated from English testing of visa applicants. Now, the company is trading on 56 PE. Now, that's 56 years of this year's earnings in order for you to get your investment back. Now, I would argue that in the next 56 years, there might be other ways of testing. There might be more disruption. There might be lots of different things. There might be a change in immigration or student policy. For us, this is extremely risky to invest in a business like this at that multiple. So I thought I'd go look at the other side of the argument and say, okay, well, how are people looking at this and why are they valuing it like this? And I looked at an analyst, one of the bullish analysts, and they came out with a valuation of $9.65 less than 12 months ago. And they're saying, we're going to value this sort of 27.1 times PE. I thought that's pretty punchy, but okay, I can understand that. And then less than 12 months later, the same analyst on the same stock said, actually, no, we're going to value this on a 45 times PE and come up with a $16 valuation. And that's where it's trading currently. Look, maybe the whole world's right and we're wrong, maybe all these companies execute flawlessly and competition never comes and competes us away. While some of the business models are new, the psychology is very familiar to us. You'll not see us at Perpetual get sucked into buying hot sectors. You'll not see Perpetual funds be pressured into buying stocks which fundamentally do not stack up just to chase short-term performance. This may hurt us relatively in the short term, but we're going to stick to our discipline, look out for red flags, find some good long-term investments, and continue to respect our unit holders' capital. Thank you for your time, and I'll hand over to Vince.
Good afternoon, everyone. My name is Vince Pezzullo. I'm the Deputy Head of Equities at Perpetual. I've been with Perpetual for about 12 years. I've been in the market for about over 20 years. I've been running the Australian Share Fund for about 2 years. I also run the Perpetual Equity Investment Company, the LIC that we have, and I'm also the PM for the Direct Equity Alpha SMA strategy as well. Now, Paul's talked about giving a broad overview about markets and why there's an importance about valuation and focusing on valuation at certain points of the cycle. Anthony's talked about some of the things we look for when we're looking for red flags and early warning signal. Today I'm going to talk about how we invest your clients' money, how do we get an idea, and how do we interrogate the idea so when it ends up in the portfolio we have true conviction about it. We certainly don't start with the index in particular. It tends to be the rearview mirror of investing. It is actually surprising how many people do use that as a starting point, particularly as the bull market gets longer. Bull markets are great at the end of democratising losses, so be wary of the index for that reason. I've been taught not to buy high and sell low, but that's what you're typically doing. You are buying yesterday's winners, typically index, because you're buying stocks that are going up and you're selling some of what is perceived losers. Right? But when you're doing that, you're also not considering the things that we think about. What's the quality of the business? What do we think about management? And what's the balance sheet like? I thought I'd point out 2 points in history about the structure of the index. As you can see here, 1900s, you've got pretty much 62% of your portfolio in rail stocks. Now, at the time, they were considered to be the tech stocks of that day and age. Okay. In 1906, the Model T Ford was launched, and they were disrupted by other forms of transport. So if you move to 1967, you see there, during the Nifty 50 times, everyone remembers those times? Not in this audience particularly. Maybe some will do. Your IBM was your biggest stock, Sears Roebuck, you had Kodak, and now Sears Roebuck has only just filed for bankruptcy recently. And does anyone remember Polaroid? Right. Now, why is it important? Because today you're looking at the FANG and WAX stocks. The FANG stocks in the US, the WAX phenomenon in Australia, WiseTech, Appen, Afterpay, etc., Xero. Now, these are considered to be invincible companies, but so were Sears and Eastman Kodak. But they were disrupted, those old companies. Now, this group of stocks have disrupted old world companies as well. Okay? But don't forget, those companies, to break those old companies down, it took a long time. Now, most of these newer companies, the FANGs and the WAXs, most of the capital goes in and out of the elevator every day. So you only really need a better mousetrap to disrupt that type of a business. You don't need a massive plant to try and, it prevents competition, etc. So today, the average life cycle of a company is about 18 years. If you go back to the 60s, it was 40 years. Now, there's a Harvard Business Review study 2 years ago that said within the next 10 to 15 years, that will probably fall to 12 years, 12 to 15 years. So in someone's investing life cycle, the first third, a fair chunk of their portfolio could disappear potentially or get taken over, taken out. These once dominant companies were very hard to break up. Okay? Customers can just change. I think you're starting to see a little bit of it today. We think for the large tech companies, it's going to be regulation, typically. There's a chance that someone in a garage is going to come up with a new product or a new way of doing things, absolutely. But I think you're starting to see it. Most people in the room, I don't know if anyone understands what GDPR rules are in Europe, General Data Protection Rules, where they've flipped the ownership of data. Now, every quarter in Europe, Amazon, Facebook and Google have to ask you for permission to use your data. okay? So that data used to be free because remember, we were the product because they were giving us stuff for free. That means we're the product. So now that data has an inherent cost, and the cost is a fine. Now, Google and Facebook in particular have been getting routine fines in Europe for breaching. You think how many customers they have? They're going to breach all the time. And only as recently as yesterday, you had the Department of Justice launch antitrust proceedings against the big tech stocks. That's the first chink. Right? When they start antitrust proceedings, they're not doing it because they're having a go. They think they've got something. So again, that could lead to different business practices. Now, we've been here before. Okay? This is not new. I think this example might sort of extrapolate what might happen. Okay? So this stock on the left here, the yellow bars represent the earnings. Now, this company's grown 28 out of 30 years. Okay? It was an earnings powerhouse. They bought back about $120 billion of stock, generated cash, etc. But why did it fall 75% from the peak? What stock is it? All right. So at the peak, it was on 75 times. Now, that actually looks reasonable compared to today's tech stocks. Okay? Because a lot of tech stocks today that are coming, and Paul mentioned it earlier, people are ascribing value to businesses that don't make any money. Recently, Uber, the CEO, when it came on the roadshow, and he stated, "We may never make money." In that disclaimer part, that's the only part that really matters. We may never make money. Or WeWork, basically accommodation for companies sharing. They have an earnings number called Community Adjusted EBITDA, which is revenue less, don't include the expenses. That's their basic earnings. So when you start going up the P&L to justify a valuation, start to worry. That should be the size of your investment inverse. It should go the other way. So why did this stock just derate? The market just described a lower value. Now, we talked about value traps, and that's what we have to think about every day. Are we buying a declining business? Can we just be spending the same amount of money and the same PE but still lose half our investment? Well, this is a growth trap. And there's just points in time when the herd or the market decides to derate you, it's going to happen anyway. It took you 15 years, if you bought in 99, to get your money back. 15 years, again, 1/3 of someone's investing life cycle. Now, it's done well after that, but that's quite a head fake position to try and regather. It's quite astonishing that the tech sector, which has actually the shortest life cycle in equity history, it is the shortest life cycle, is actually afforded bulletproof multiples. We should technically be paying less for businesses which can disappear so quickly. But we tend to, as Paul said, we worry about the upside rather than can this be disrupted today? And I think today you're starting to see the first elements of old growth, the Googles and Facebooks, being competed against, whether it's via government or the better mousetrap. So today I'm just going to go and just refresh everyone's minds. This is our process. It's the same process for the last couple of decades. It hasn't changed. Any stock that goes into our quality universe, so it's just to get into an investable universe that we will pick our stocks from, has to tick these 4 criteria. So quality business, this is where, as Anthony mentioned before, we try and assess the value trapness of it. We try and work out ease of entry and exit of capital, the quality of the quality of the competitors. Are they number one in their sector? Are they number one in their industry? Where are we in the life cycle of the business typically? Where are margins relative to history? All those sort of things. Secondly, we look at conservative debt, and Paul mentioned that quite a bit. I think it's pretty important because this sort of bails us out of trouble when things blow up. So 50% net debt to equity as a starting measure, or 3 times EBIT interest cover across all companies. And we will sell a company if they breach those measures. Typically, say a company has drifted into the danger zone, as we would see. We'll call the company up, talk to them, what are you going to do to remedy this, raise equity, sell an asset, what are you doing? If the commentary is literally, we're waiting for the cycle to bail us out, we'll get back to the office and we'll pretty much liquidate the entire position that afternoon. Because that's your starting point of getting yourself out of trouble, you're going to get found out pretty quickly. And sound management, this is the whites of the eyes test. We've talked about this before. The reason you do the company visits, it's not to assess when things are great Everyone's a hero in a bull market. When everything's going well, we all look good. That's easy. You want to work out how they'll behave when things go wrong. Are they going to protect our capital? Are they being conservative today when things are great so they can take advantage of the bad times when everyone else has lost their marbles? And lastly, recurring earnings. We don't buy concept stocks. As Anthony mentioned before, a lot of these companies don't make money. They have to show up a discipline to make profit. Because when you make a profit, there's quite a few stakeholders you have to satisfy. Employees, suppliers, customers, more importantly, shareholders. I want to pay you a dividend. I'm going to be rational with our capital. So we don't buy stocks that have no history of earnings. We'll buy companies that have cyclical earnings. That's fine, because you can make money out of a cyclical. But they have to generate earnings and cash as well. Today, I thought I might talk about two examples. One that we've had for a while, which has probably played out, the investment sort of played out, which is Woolworths. And then another one, Medibank, which is not a turnaround. Woolworths is a turnaround. Medibank's more of a mature company. So with Woolworths, it was a turnaround. Now, more importantly, with turnarounds, there's one thing you have to focus on, because not a lot of them work, is you always have to go into and understand, is the franchise broken? Because that's what's going to get you through. Because bad management can always tarnish a franchise, but the franchise will probably survive as long as you change the management. But if the franchise is broken, that's where we spend a lot of our time on the turnarounds. So what was going wrong with Woolworths? They were over-earning in margins. Woolworths had 8% EBIT margins, operating margins, which were record highs globally. Most profitable supermarket retailer in the world. Funnily enough, they were losing money in Masters at the same time. I suspect they were starting to push margins up because they were losing money in Masters. Remember, Masters was losing about $200 million a year. Now, supermarkets are great businesses because their cash conversion, the actual profit, the cash flow statement profit, over reported earnings, EBITDA, is greater than 100% all the time. Because Woolies gets paid before they need to pay anybody else. So they always generate a lot of cash. It was, at the time, in 2015, they were doing 85% cash conversion. They were borrowing money. The biggest retailer in the country was gearing up. Okay? More importantly, with a retailer, your lease book, because remember they just have leases, that's effectively debt to us. We think a lease book is debt because it's usually a 10-year plus commitment, and if sales start to go down, and like-for-like sales were going down in the core business, that's debt that needs to be repaid. You get significant earnings leverage to the negative when that goes against you, when your like-for-likes are negative. Now, why was all this happening? You can bring it back to one thing, management incentives. If you look at how the management was behaving, and then you look at their STIs, short-term incentives, they were pretty much being paid to generate short-term gains, short-term profits. Right? They were opening up more stores than Australia, the entire country needed. Australia has a population growth of about 180,000. You need about 9,000 people to support one supermarket. Okay, so about 20 to 30 supermarkets a year. Woolworths is doing that on their own, and they have about 35-40% share. So they were rolling out space because they wanted to grow short-term profit. Now, STI, that's where we spend quite a bit of time thinking about how is the management incentivised. So why could it be a good turnaround now? We're asking ourselves, okay, why could it be a good turnaround? What needs to change? It is a good franchise. Supermarket retailing, particularly if they're number one, is a great franchise because you control the market effectively. The market structure is quite good. Woolies, Coles and Aldi, which is a discount supermarket, and the rise of discount supermarkets is not new. They've represented about 20% of the supermarket for the last 40 years. You've always got a discounting supermarket in the market. They're usually 15% below the number one supermarket. And the barriers to entry are usually quite high because the supply chain, moving a packet from here, from the farmer to your shelf, is quite a complicated process. And to do it well, to make money on it, is really hard. You need significant amounts of scale. And more importantly, the last mile, which is the connection to the customer. How close is that Woolworths store to the customer? Because that's the ownership, because shopping is convenience. So from that, as the stock started to sell off, we started looking at, right, if you're going to look at understand and see if the franchise remains intact, you need to do quite a bit of work in-house. So we've got a large investment team, we've got a lot of analysts. We threw quite a few analysts into the project to understand, let's work out those things I mentioned earlier. Is this franchise intact? So we did our own proprietary research in-house because the sell side was not interested at all. They went into straight mania mode and started saying it was a sell. So we looked at the lease expiry risk, understand how big the book was, where the stores were, how long is the lease risk. So if they don't turn around sales, how much are we on the hook for here? How much can sales go down? How much can profit go down? If sales don't turn around quick enough, what could happen? So we're thinking about the downside. So you look at the lease expiry. We spent quite a bit of time analysing that through the accounts. We actually were running pretty regularly grocery surveys, seeing where are Woolworths prices relative to Coles and Aldi. Because the reason they got 8% margins is because they were at 20% premiums, even to their competitor in Coles, which that shouldn't be the case. Okay? But they let it drift out there because of short-term incentives. So we ran grocery surveys really regularly to see where they were. We actually, on the last mile issue, we hired an external company that specialises in demographic modelling to try and understand where a store should be. And they actually service the supermarket industry, the guys we found. Where the store should be, what sort of growth corridor does it need to be, what should they be doing in sales per square metre, understand all those things. And actually, quite interestingly, what we found out of that is Woolworths has 90% of the population within 10 k's of a store. All right? It's actually better than Walmart. So that last mile is a key competitive advantage for Woolworths. And then we did the good old, and you probably never get this in history, 4 fund managers going to a Woolworths in a minibus. See the good Aldis, the good Woolies, the bad Woolies, see what store formats are working, try and get a head around what needs, because there's going to be some CapEx required. And what happened was fortunately the board changed. New chairman who started refreshing the board with Gordon Cairns, and he changed the management. And obviously everyone remembers that the management strategy was to whack $1 billion back into the business. And they tanked their margins basically from 8% to about 3.8% with that investment. Because they needed to get the customer back, okay? Because they had lost the customer. Customers not listening, they were losing share. It actually allowed Aldi to compete with them. Because they had margins so high, Aldi's happy to compete on 4 or 5% margins. It allowed them to grow up against them. So what were the early indications that were to prove to us that the franchise was intact? More importantly, with a business like this, it's improving NPS. So Woolworths had turned around their NPS score. So they were starting to see the customers starting to listen again. They started to think about them as maybe, the value was there. So customer perceptions had improved. More importantly, after about 9 months, and this is really important when you've got a massive lease book that Woolies has, is like-for-likes turned pretty quickly. So they were going from -1, 1.5% to plus something. And on a leveraged balance sheet, leverage in a sense, you've got operating leverage in the lease book, you need like-for-likes to go up. So you saw it pretty quickly. That's pretty important because it tells you the customer is actually still engaged with Woolworths. More importantly, and this is to the management, we talked about the whites of the eyes. So the risk was management gets lazy, they got the customer back, you know what, let's just maximise short-term performance. Okay? They've actually got the entire industry where they want them right now, Woolies, because they're outgrowing them. So sort of an indicative a perception from the management that they will not repeat the sins of the past was in March. Woolworths ran an online only a sale of 50% off everything in the frozen food aisle. Okay, I have to read directly what Brad Banducci, the CEO, said. It was completely unprecedented. In effect, we did our Christmas volumes in that week with less than 12 hours notice to our customers. Now, Christmas is peak selling for a retailer, right? They did their Christmas volumes in a week, which tells me one thing. Firstly, customers are still listening and they value the relationship. Secondly, in a click and collect world, you need to have your stores as close to the customer because most of those sales are click and collect, okay? So you can actually make money out of the sale. Deliveries to the house does not work for a retailer. It's too expensive. The logistics don't stack up. And it tells us that they're taking that, we call it the price umbrella. They're not over-earning anymore, and they're going to make sure that their competitors can't come into the market. That's why this Amazon threat, we scoff at it quite frankly. It's illusory. It doesn't really exist. Because in retail, if you look at Woolworths, Amazon offshore, they've been in Canada for 10 years, and they've literally got no share in supermarket retailing. But in the UK, they've got barely a couple of percent. So we think it's a false economy that we actually think that Woolworths has a leadership position. Now, I want to talk next about the psychology at the time. And Anthony talked about psychology. Paul talked about the psychology at the moment. Now, at the time, we didn't own any shares in 14 because the manager were over-earning. They weren't investing for the future. They were looking at short-term gains, and believe me, the manager got paid in the short term. But look what they did to the business in the meantime. And at the time when it was about $36 to $37, the entire sell side had the stock pretty much on a buy with valuations in the 40s. So they were happy to capitalise 8% margins forever. Record highs. We talked about where we are in the cycle. Record highs. But as the stock started to tip over because the like-for-like sales were negative, Masters was costing them a fortune, etc. That's when we started doing our own in-house research to assess, right, is there going to be an opportunity? We didn't own any shares at that point. What are we looking for? What are the early signals we're looking for? And for us, it was actually changing management and changing board. Because then we can have a conversation with them about your strategy's all wrong, change it. So we started establishing a position down at 24, we started entering, and we're buying through that period. Notice how it took 12 months to 18 months. Actually, even after like-for-like sales had started to bottom out, the market still wasn't interested. Now at the bottom, the valuations from the sell side had gone from $38 to $40 to $14. Right? It would have made it the cheapest retailer on the planet at that, even though they've rebased their margins to 50%. So you can see that people are sort of hardwired to be overly negative at the bottom and overly optimistic at the top. So where are we today with Woolies? So we've halved our investment. At that point, at the bottom, we had $1.5 billion invested in Woolworths. Right? It was the largest active position in every single strategy we run, from 6% up to 10% active weight. So we're convicted. When we feel with our in-house research we've got a view on something, we'll back ourselves. You think about $23 to $24, actually average price is between $22 and $23. Stock price in the last couple of weeks. We always thought Woolies was a $34 stock, run well, if it was run well. We got to that price, we've been selling down, we've been taking profit. So we've got about $10, $11 in capital, but we also received $5 in fully franked dividends in the period. So in the space of 2.5 years, and this is why I want to bring this point up, in the space of 2.5 years, you got $16 of return on a $22 stock. How much risk do you think we took? At the top, everyone think there was no risk. And at the top, bottom, everyone thought there was maximum amounts of risk. But the franchise value was still there. We think, as Paul mentioned, the risk-adjusted return we're taking is very low. Sorry, the risk-adjusted return are very high, the risks are very low. Now, the reason I want to talk about that is because that sort of has played out for us as an investment. But Woolworths is still, while we think it's at fair value, we're in an expensive market. There are other stocks which are less quality that are trading on the same sort of multiple. So we still hold some, but we're not maximum overweight. So I want to move on to the next stock, which is Medibank. I think it's interesting because Medibank hasn't done a lot in the last few years. If you think about the type of stock it is, it's about 18 times. It does a 22% ROE. It has a net cash balance sheet. It has $450 million of cash on the balance sheet. Now, why has it not done a lot? Look, the private health industry hasn't got a great history. The product's not great. Okay? There's no value in there at all. They've been blamed for, most of the insurers are blamed for cost inflation and a lot of out-of-pockets at the moment. There's a perception that there's over-servicing going on, particularly as a culture in the private market, that there's a lot of over-servicing going on. The ALP was quite hostile to private health. And only on Monday, APRA came out with a statement to the private health industry saying, listen, if your strategy, business strategy, is to rely on the government to bail you out with high premium increases, think again, come up with another strategy. So the regulator's telling the industry, get your proverbials together. You're not going to get bailed out by anyone. Okay? So the industry is actually quite poor. And you think about it this way. For 30 years, the service providers, which are the hospitals and the doctors, the specialists, etc., they pretty much send a bill. The only time that a private health insurer knows you've had a treatment is when they get the bill. They had no clue. Okay? And what was happening is those private health insurers, because they weren't really quite innovative, they weren't particularly innovative, they just, if costs are up 8 to 10%, they'd go to the government and say, we need 8 to 10%. and the minister usually used to rubber stamp it. So the asymmetry of information was quite poor. Right? You and I don't know what a knee arthroscope should cost. We've got no clue. Right? So it was pretty much cost-push inflation the entire time. So who was advocating for the members? Nobody. You didn't need to. But now we've run into a problem. That is affordability. Right? Affordability is causing people to drop out of the industry. So that's the setup for us. We're thinking, okay, this is a bad industry. It's got a history of bad behaviour. Can a good operator who's invested well change the industry or take a leadership position? So again, we started doing our own internal research. So we put 2 people on this. It took about 3 to 6 months, where they pretty much threw themselves in, and we're looking at, we've got to understand 3 things about private health. Firstly, hospital operators, we're trying to understand the supply of beds. Now, don't get romantic ideas of that. Hospitals are good businesses, but they are like an airline. When you open a big building and you've got a bed in it, unless it's filled, you don't get paid. So they are encouraging volume growth. So whenever they expand beds, put more beds into the system, they have to fill them. They have to promote volume. So we want to understand, what are the hospital operators doing? We spoke to every private hospital in the country and a lot of the not-for-profits as well, to try and understand what are your intentions for capital, your expansions in the next 5 to 10 years. Try and get a head around supply of beds. The second thing we looked at is for the private health industry is what's happening on their costs, because they try and pass that on. They'll try and make the health insurer pay for it. The costs will be the EBAs, staff are about half the cost of a hospital, etc. Trying to understand what they're going to try and push onto the private health insurer. And lastly, so we've got supply of beds, costs for the health industry, the hospitals, and thirdly, volume. Now, the people that control volume are actually surgeons. Okay. So we ran several surgeon surveys, about 100 surgeons at a time, from very old surgeons that have got a big list and very young surgeons that are coming into the industry. And we're trying to understand what's their perspective of what's going to happen to their volumes going forward, based on new treatments, is there new technology comes out, etc., all that sort of stuff. So we also looked overseas for best practice in treatments as well. What's changing in medicine? Because you've got to get ahead of that, because that can materially affect volumes. Now, what we found was quite interesting. We've identified internally, and all this data is public. It's out there. You just got to go look for it. There's heaps of Medicare stats. There's a lot you can get out of the private health industry. Just speaking to a lot of people tends to help you get. What we try and do is we try to join the dots. That's all we do. You're never going to get a silver bullet in this business. You've got to join the dots through the whole period. And what we found is, these are some key stats we found. We've got quite a few. Is that for some reason in South Australia, there must be a footpath problem, because you're 3 times more likely to have a knee arthroscope in South Australia than you are in New South Wales. 3 times. Okay? And the number of knee operations actually in the last 5 years has fallen by about 50%. Because unfortunately, men and ladies over 50, knee arthroscopes don't do anything for us over 50. We've just got old knees. And the medical community is now starting to say that. There's no point doing them. That doesn't work. You're 3 times more likely in the private system, 3 times, to have a knee and hip replacement versus the public system. This is all volume going into the system. Remember I said to you, hospitals need volume. You're twice as likely to have a caesarean birth in the private system versus the public system. And more importantly for us, and this is the part we found where there is an actual arbitrage on the system occurring right now, is that rehab volumes, which is non-invasive treatments, are growing at 15% in the private system, and they're growing at 1% in the public system. Now that is all feeding into premiums the entire time. Now, Australia is the only country which is still adding beds to the system. The only country in the OECD that expanding bed numbers. The rest of the world's actually doing it very differently. What they're starting to do is do health outside the hospital. So there's no doubt that the PHI system is actually littered with over-servicing. You've got to think about a surgeon. They've got to balance up a clinical decision, and they are a business as well. So they've got to do some volumes. They've got to treat people. Okay? It's like asking your hairdresser if you need a haircut. Some will get pushed through the system. So why do we like Medibank now? what gave us the confidence? A bit like Woolworths, what gave us the confidence? From all that work we did, we went actually, after we did all that work, got all these numbers, we spent a bit of time with Medibank to understand the business strategy. Are you just going to sit around, ask the government for a premium increase to bail you out, etc.? So why we liked it is they've actually turned around operationally already. They actually are best in class in the private health industry, which is, look, it's a low bar, but it's a start. They've actually spent their money on their systems. They've digitised pretty much the entire business they've got. They actually collect quite a bit of data. Now, a lot of the systems that the private health industry run off are 30 years old. So Medibank with a digitised system gives them quite an advantage because they are collecting data. They've set up a payment integrity unit. I mentioned to you before, the first thing that a health insurer finds out about a bill is when they get it. Well, now they've actually got forensic accountants looking at every bill and asking the hospital saying, can you just prove to us that that person did receive that drug? Send us a script. Send us the information. We want to know if they're getting paid. So we're actually now starting to get the premiums down by advocating for the member. Okay? They've launched at-home care. Most people might have seen a Medibank Rehab at Home ad. It's important because the numbers, it's purely a numbers game. Rehab in the home for Medibank, if they can get you to do a rehab for knees or hips, etc., at home, if the clinician allows you to do it, it costs Medibank about $2,500 per patient. In the private system, the hospital system, it costs you $8,500 because half of it is just accommodation. That's where the arbitrage is. So what Medibank is doing is they're looking for arbitrage in the system, and overseas this is happening everywhere, where a lot of treatments are actually being taken out of the hospital outside of accident, emergency and trauma because the clinicians are working out a better way to do it. They've actually partnered with the South Australian government now because Medibank has a health services business as well, not just a health insurance business, where they're actually managing mental health patients for the South Australian government because a lot of them fall through the system. So they're actually trying to grow the health business part of the business as well. But more importantly, it comes down to numbers. Now, what's convinced us that things have turned for Medibank is their complaints are down materially. All right? Medibank's market share is about 27%. Their complaints about 3 years ago were about 30. They're over-indexing. As of the last half, they've fallen to about 20. So they're actually getting complaints less than their market share today. That tends to lead to one thing, and what that one thing is Medibank's growing their market share for the first time in 10 years. They're actually gaining customers. Now the system's shrinking, but Medibank is actually winning because they're gaining customers. That's coming from someone else. And they continue to be innovative. They've launched only last month or 2 months ago the first loyalty program where you can gain points by staying healthier, staying out of hospital. That's what they want to do, keep you out of hospital because that's where the bills stack up. And you can offset those points against premium increases going forward. So again, where are we today on Medibank? Net cash balance sheet. We've got a less hostile government. The Liberals aren't as hostile to private health. We've potentially got capital returns. It does about a 4.5% fully franked yield today. And they've got excess capital, so we think we can see some of that come to us. It fits the profile that we have. More importantly, it's a bit like Woolies. People thought it was a boring old business, but people don't spend the time to check under the hood. What's the business actually doing? Now, hopefully this gives you a perspective as to what we do in our big couple of positions where we take our biggest active weights. This is what we do. We only back ourselves when we've got that sort of conviction. And it sort of proves to you that we are an active manager. We will back ourselves, and then we look to be a patient. But when we see opportunities like a Woolworths or a Medibank, we'll have a go. Thank you very much. I'll hand back to Adam Curtis. Thanks, mate.
Importantly, thank you, ladies and gentlemen. It's good to see many familiar faces. Great to see many new ones. For those of you I haven't met before, my name's Adam Curtis, and I'm going to host a brief Q&A session to finalise the event today. And I'm not taking anything away from three great presentations. I hope you can reflect that this is the best of all the sessions, because ultimately it's your chance to ask your questions to the team that take their role in managing your clients' capital very seriously indeed. Thank you for the opportunity you've given us today. I'd invite the gentlemen to join me on the panel now, and whilst they settle in, just a reminder, you have the opportunity to text in questions. For those that want to raise a hand, shortly following there'll be a microphone So whilst the gentlemen settle in, I just want to make a few very brief comments. Many of you I know, and many of you know I've worked at Perpetual for 10 years. I'm proud to work at Perpetual. We all are, but we're prouder to work in financial services. We genuinely consider that it plays an important and a vital role in securing the future that many Australians are striving for. But I think it's undeniable that it's an industry that has suffered some brand damage of late. I lament this. It's a shame because I value what you do. I see it. I see the benefits that the clients get and the community at large have received. But it's fair to reflect that the brand of many can be damaged by the actions of a few. As Rob said earlier, at Perpetual, we believe in the importance of financial advice, but we also believe in the importance of active, considered and aware investment decisions. We have different roles in this room, but we share a common purpose. That is to help our clients get to where they want to get to with the least amount of risk and the least amount of hassle. In recent years, a lot of it led by central banks, we've seen massive liquidity, a cost of capital that once we could only theorise around, massive leverage, high valuations, a marketplace full of risk but little pricing for this risk, and a world of fundamentals appears forgotten. But hidden risks or suppressed risks do not mean no risks. And if there was a common theme from any of the speakers today, it is that. We cannot ignore the red flags. We cannot ignore the likelihood of fundamentals or mean reversion to markets. In this sort of climate, active management can suffer and people can question its value. But we all consider the importance of financial advice and we all consider the importance of active management, and those two levers together give our clients a better chance of fulfilling why we are in this room today, to help them achieve their objectives. More often than not, I leave a meeting with your officers or a client seminar and I'm reminded of what you do, the value you get for your clients. And I hope after today you're reminded and leave here with the same confidence of our role and our relevance in your portfolios. I'll invite questions. Anyone who wants to put up their hand, they're very welcome to do. I'm conscious of the fact that we've got Nathan here, and Nathan, you haven't yet spoken, so I might throw to you, Nathan, straight away.
Sure.
We're here to talk about securities. I know you've got some pretty exciting positions in your portfolio. Is one of them that you'd like to share with us today?
Yeah, sure. Thanks, Adam, and conscious of time, so I'll keep it pretty brief. Look, exciting to me, but perhaps not exciting to everyone else at the minute. So I own a company called Event Hospitality and Leisure, which, as Anthony has touched on, Perpetual has owned for a long period of time, and we've been adding to recently. I think it looks as cheap as it's probably looked for over a decade now, and why that is because this is a company with some operating businesses that have a little bit of earnings volatility and drive sentiments. They own and operate cinemas, they run Thredbo Alpine Resort, and they also have a very strong hotel business with over 9,000 rooms, but there is a little bit of volatility in their earnings. But what I find really interesting about the company is their unique and high quality asset base. So over its long history, over 100 years, they have built up an outstanding property portfolio. A lot of it concentrated in Sydney, Melbourne CBDs, and certainly hotels up and down the east coast of Australia and also in New Zealand. And today, that property portfolio is worth $2 billion, which pretty much covers your entire market cap of the company. Adjusting for a little bit of debt post the sale of their German business and a rent that would be imputed between those two, the property assets back to the operating assets, you're paying 2 times earnings for the operating businesses. So whilst there may be some near-term headwinds or volatility in some of the shorter-term metrics, you're really not paying for those businesses at all. And they're the sorts of things where we're happy to be patient. It's a business that's grown consistently over a long period of time. It's well managed, with a great balance sheet and offers a nice yield, and we're happy to have those sorts of businesses in the portfolio.
Thanks, Nathan. I can see a question there. Hopefully we can get a mic to you. Elise, thank you for that.
This is fired at the panel, and we know that you sort of value approach investors and that, but this is a two-pronged question, and I know you're sort of more on the touch of conservative, but what's wrong with a company like Rio Tinto or some of the mining? They're like around at the moment, they're around $100 a share. They've got a lot of cash in the bank. They've got a lot of positives. It's a two-pronged question, but what's wrong with putting a bit more dollars on that side? Because one would think that, I'm not like you managers, but I would think if you look at all the sums and different things, there's got a lot of growth in a company like Rio Tinto. And what's your thoughts with lithium? And I know it's a smaller company, and with Perpetual, that'd be too aggressive to probably touch a company like Pilbara Minerals or someone like that. But what's your feeling with the growth in the lithium industry with electric cars and things like that?
Okay, I'll take the Rio question. So Rio, there's nothing wrong with Rio. It's got a great balance sheet. It's churning out quite a lot of cash at the moment. But I guess what's wrong with it is where we are in the cycle. Iron ore is elevated for a temporary period of time because of some supply outages in Brazil. We think that the iron ore price where it is not sustainable. It's so far away from what a reasonable mid-cycle price is that you'd be better off taking your profits and looking for other opportunities. Our investment process, typically, we try and put together a portfolio that is conservative but has, the companies typically have low operating leverage, which means there's not a lot of volatility in earnings. And a lot of the cyclicals that you invest in, what's important, whether it's Rio or BlueScope or any cyclical, is at what point are we in the cycle and what are the outlooks and expectations. And we feel right now for iron ore price, people have got huge expectations about where the price will be in 6, 12, 18 months' time. But we're not sure that that's actually reasonable. We think the price will be significantly lower. And that's probably why we're not in Rio. Lithium, on the other hand, Pilbara Minerals. Do you want to say anything about lithium, Pewsy?
Look, the first comment I make is in having been appointed as the ethical manager, my fund actually can't own a lot of mining and resource stocks, but I did run the smaller companies fund, co-manage the smaller companies fund recently. So we had a look at some of these stocks in the past, and we actually had an exposure to lithium through Mineral Resources. And to be honest, we thought that was probably the highest quality lithium asset in Australia by virtue of the long life nature of the asset, so 30-year plus mine life, enormous resource, at pretty attractive costs. And when we're looking for resource companies within Perpetual, we're looking for long life, expandable assets in the bottom 2 quartiles of the cost curve, and the Wodgina asset within Mineral Resources fit that bill. And look, we think our view was validated there when Albemarle came and took 50% of the asset late last year. So we think that's a high quality asset. In terms of Pilbara and Kidman, look, we used to look at them a little bit within the smaller companies context. What we thought was the whole sector got very hot there for a period of time. There was a window there where the spodumene price shot up. Naturally, a lot of supply came into the market, but it was a craze in the market, and it's kind of the thematic. But we're trying to detach ourselves from that and look at the fundamentals. And the reality is the lithium is evidently very abundant, and perhaps some of those spodumene assets in the west are not the lowest cost assets when you consider them up against some of the brine producers in South and Latin America.
It's a good question. It's a question that we've got a little bit on the tour so far about views on Rio and BHP. You know, and Paul, you've spoken to another stock that you've got an interesting position in. Do you want to share that with the audience today?
Yeah, this stock has iron ore exposure that's actually undervalued in the share price, and the stock is Iluka. Iluka is the world's largest zircon miner, second largest rutile miner in the world. It's got no debt on the balance sheet, but it's been a very big underperformer, especially in the last year. And they've got the world's highest grade zircon asset, but that grade is actually starting to come off. We can see the zircon the market actually tight in the next couple of years. But where we're really interested in Iluka is it has royalty over Mining Area C, which BHP owns. And BHP have been conducting an expansion of Mining Area C called the South Flank expansion. And it's a royalty stream that is significantly undervalued, and it's not taken account by many of the sell-side analysts. So we've been buying Iluka for that reason.
Here we are at Crown. I was guessing that we could get a question on this, but we've had a question from the audience. James Packer selling Crown shares. I don't know, Anthony, Paul, you've had exposure. Do you want to talk a little bit about that?
Well, I think what I'd say is I own Crown in the concentrated equity fund. The development is a poor development for minority shareholders. And the reason why is, with 2 strategics on the register now, with Lawrence Ho coming in, it really takes out any of that blue sky valuation we were, as investors, expecting in a proper takeover scenario. So That's quite disappointing. His motivations as to why he's doing it, I mean, we've all read the paper. He said he wants to diversify. Maybe, I mean, I think he could have done it in a better way where he could have got more value for his strategic stake, but that was his decision, not ours.
Another great question. Do we own any CSL, Vince? If you don't, did you previously? And on what basis did you sell out? Great question, Ray. Thanks, Vince.
I had to buy CSL because it became 5% of the market, and that's my maximum underweight I can be in a stock, so I was forced to buy it at one point. Actually, you know what price that would be, $230. Look, we haven't owned it because, as Paul mentioned before, we've got a pretty strong buy-sell discipline, and a stock like CSL, people are paying more and more for the same dollar of growth compared to 5 years ago. It used to trade on about 22, 23 times earnings. It's now 34 times. And for us, there's no red flags, it's okay, but it is starting to look a bit stretched operationally. There are some things going on in the business offshore, which this market tends to pay no attention to. So we used to own a stock called Shire, which was the same type of business, bit of a hated stock offshore. It was on 9 times because it was hated management. But the franchise was still intact in our view. So we own Shire to cover that underweight in CSL. Not as large, but fortunately that got taken over last year at a 45% premium, and that sort of helped us out. But it's not really a red flag type stock. But when you're on that highly priced, you only need a few little things to start to play against the stock, and the market will move on. And you've already started to see a little bit of it now. It's come back from $230 to $205. So no real red flags in there. It's just valuation issue for us.
Feel free, any of the panellists that might want to jump in here. Obviously, we often get comments on views on banks. Yep. How are we seeing the banks post the Royal Commission? Are they likely to recover significantly?
I think significantly is probably too strong. I think if you rewind the clock maybe 6 months, there was a lot of people out there saying, I can't own banks. We've got the Royal Commission findings coming up, and I've also got a Labor likely to win with all the negative gearing changes, etc., etc. We've now passed a couple of those risks in a large way. So we feel that the risks associated with investing in banks probably come off a little bit, especially if we start seeing property prices improve. The one caveat, probably two caveats, but the one main caveat to that is that ASIC has changed the way they're going to look. They need a feather in their cap, and so you just don't know what they might come up with or what they might find, and they're going to go for the jugular. They've been given carte blanche, so you've got to really that's something from left field which could hurt you. And the second thing in the short term is in the absence of credit growth, margins will still come under a little bit of pressure, and you're seeing that they've all apart from ANZ passed on the full rate cut. So we think that a lot of the risks have sort of in the rear vision mirror. We think they yield great fully franked dividends, which is substantially sustainable. But we don't think it's going to be a massive recovery.
Obviously, you spiked a bit of interest with your Medibank discussion. Vince, Ramsay Healthcare, I'm feeling you could comment on that.
Yeah. We don't own any Ramsay for the fact that the work we did on Medibank sort of suggests to us that volumes are challenged in Australia, and you're definitely seeing that. The market, and to a point that Anthony brought up before, what have they done in the last 6 months? They made a significant acquisition offshore in Sweden, which is actually typically an at-home care type business. It's not actually a hospital business, it's mostly at home. So we're finding it quite interesting that Ramsay are starting to sort of realising the world's moving on, but they're making large offshore acquisitions to what we think might be papering over weaker domestic growth. And Australia's still 50% of their business. So we're a bit... The market doesn't seem to have cottoned onto this yet, so we don't own any at the moment. We think below 60, the 50s, it might look quite interesting to us. But we're still well north of that. We're about $69, $70. So
it's got some great property assets.
Yeah.
Is probably the one thing which probably protects you on the downside. But it is a fixed cost business, and you've got the nurses. The cost of nurses going up by 3 to 4% a year.
No, it's 4 or 5.
4 or 5% a year. It's hard if you start getting the healthcare funds really push back on them. So you could get that margin squeeze. But yeah, it's the thing which probably gives them downside protection is the property portfolio.
But to that, sorry, just lastly, we're doing a bit of work right now on the way health services might be provided where you don't need a hospital at all.
Yep.
There's a lot of vacant land around the country. Vacant buildings, not vacant land. Vacant buildings.
The toughest question, but often the best question. Where can we see, predictions in terms of sustained downturns in markets, in economies, and hence Perpetual achieve better relative performance? Anyone want to, I suppose, talk about that? In essence, you have, talking a little bit about the red flags, talking about the market conditions. Anyone want to elaborate on that at all?
What I'd say is we don't need to see a downturn for Perpetual to perform better relative to peers. What we do need to see is some rationality return to the market, and we're starting to see pockets of that. So, some high-flying stocks that we haven't owned, and we've been scratching our head around valuation, are starting to come back to earth. A prime example is Costa Group. This is a company that grows blueberries, avocados, strawberries, raspberries, citrus. It was trading at 34 times earnings because it had a bit of growth. Got as high as $8.80. It's had 2 successive downgrades, is now trading at $3.40. So, a lot of what our underperformance is stocks that we haven't owned that have been re-rated significantly, and the stocks that we have owned just being left behind, doing pedestrian performance relative to the market. So I think when there's more rationality, and we're starting to see that because some of the high flyers are coming up with earnings, disappointments, we're starting to see them derate. Then we start to see higher quality businesses that we own, typically, being rated correctly. And I think that's, so we're not waiting for the market to turn down for us to outperform. I think that once rationality will return, that's when you'll see an outperformance.
And Vince, that was a conversation we were having outside the room earlier in terms of rationality. We were talking about US markets and how well bid some of those markets are, but some of the alarming factors in terms of profitability on the exchanges.
Yeah, so one fact that we've picked up on recently is the Russell 3000, that's the small cap index. A third of the companies listed on the Russell 3000 make no money, right? Typically, that happens in the middle of a recession. It's actually happening while there's growth. So there's a lot of companies that have come to the market which make no money. We talk about fads, make no money, and you've got accommodative interest rates already and expansionary fiscal budgets, and they're making losses today. So I'm trying to work out if there's a little bit of a headwind somewhere, what's going to happen to your money there. So that's, again, it's another bit of a thing we think about. At some point, the balance sheet does matter. And that's, like Paul talks about, rationality. That's you're going to get to at some point where people think about, actually, how am I going to fund the next expansion? Or am I going to, what's the Mark Twain quote? I'm less worried about the return on capital and more worried about the return of my capital. At some point, that will happen.
Thank you. Question from the floor.
Yes. Unfortunately, I'm one of those dinosaurs of the industry that I'm so old now, I'm going to soon jump on my horse and ride off into the sunset like John Wayne. But given that, it's leading to the question about our ageing population, and one two-fisted in way. What's your digression on the aged care sector, either either with companies like Mirvac and Lendlease and Stocklands in either retirement villages or actually aged care facilities? I'm not looking at the aged care services such as Ryman Care, etc., but where because we have a greying of Australia, where is that all going to lead to? And from a pension point of view, what's your insights towards things like infrastructure funds that are going to provide pension incomes for our clients?
I'll talk quickly about the aged care. Obviously there's a Royal Commission going into the aged care sector at the moment. It's quite different. We've been following it very closely. It's quite different to the Bank Royal Commission insofar that it's not really a gotcha. They're actually trying to find a long-term solution. The sector's had 12 reviews in the last 6 or 7 years. So what's the future? Yes, there is going to be massive underbuild of aged care facilities over the next few years. I think it's about 50,000 beds need to be built in the next sort of 7 or 8 years as we get this ageing population. The problem that they've got is there needs to be, well, you had a government 2 years ago who cut funding. That needs to be reversed. And at some point in the future, the for-profit, they need to motivate private capital to build new facilities. And so the government will know that, and they'll continue to work out a way to get that to occur. Now, the one which probably leaps to mind in Victoria is Regis. It's one which has predominantly grown through greenfield expansion. And we feel that despite the headwinds and the negative publicity associated with Royal Commission into aged care currently, that there is going to be a massive demand for infrastructure, physical infrastructure, aged care homes in the future. And we feel that there are good operators out there. Only 6% of the overall market is listed. Half the companies out there are non-for-profits. A lot of those non-for-profits, like the facilities are 30 or 40 years old. So there is a tremendous opportunity for a good operator, both not just a property developer, but also someone who provides good aged care to be able to generate decent returns in the future. And the reason they can generate good returns in the future is the government needs to motivate private capital because they don't want to have it on their own balance sheet. They need to have third-party capital. So yeah, there's an opportunity there. I think there was another question.
So the one on infrastructure, I think we can all understand why infrastructure assets are highly sought after in a very low interest rate environment. But again, where are we in the cycle is the most important, and interest rates are historically low. And the value of these assets continue to get bid up. But what really concerns us about the listed infrastructure and even the private is the amount of debt that you're putting against some of these assets. And you look at Transurban, it's probably 8 times debt to EBITDA, and people are quite comfortable, to say, well, it's a bond proxy, and it is. But if the growth doesn't transpire, there's still a whole lot of debt, and you have to give the concession back at some stage. So yes, we understand why people are buying these assets today and their long duration, but the amount of debt against these assets is what concerns us.
To that point, that railroad chart I brought up at the start, half of those disappeared because of the balance sheet. So they were geared up to those sort of numbers back then in the 1900s. So they're great assets, but it's the capital structure that blows them up.
Observation from you here on the stage, you're likely to be a user of the event group, I'd say, at Thredbo before you joined at the aged care facility, from what we can see here. Many good years left ahead of you. Conscious of the fact we've run out of time, but the investment team are here to talk with you. So for those that can stay around, please do stay around. But I am conscious of the fact that our time has come to an end. But please, thank you for your time. Dan, I'll encourage you back to the stage. But please, for those that questions weren't unanswered, please join us at the end of the day. Thank you.
Thank you very much, Adam. I've just got 3 quick messages for you. One, hopefully you saw this bookmark that was on your seat. It's got the new Advisor Hub on it, which is a new website dedicated to the advisor's needs rather than our broader business. So please have a look at that. Secondly, do your CPD points, so you've got to fill out your feedback form. And thirdly, as Adam mentioned, if you've got any further questions, please stay around. The team will be here for the next 10 or 15 minutes to answer those. So thank you very much for coming today. Really appreciate the support you've shown our business. Good luck with the rest of the year. Thank you.